good morning, all. Thank you for attending for today's session. And I think today that's the most important part how we can create a wealth and build financial freedom. I think that's something which always be a top of everybody mind. But always there are multiple challenges, especially for NRIs, considering the way the overall basis, global fund transactions, compliance, and the returns. So all those things impact the whole investment decision. That's a one reason what we thought of that. Okay, let's first understand that how things are moving and how somebody should plan on the overall asset allocation so that we can work on a overall basis. I think the most important part today, if you look at, I think India as a market globally, if you look at, is going to be the best performing market after US. So I think the first foremost thing, I think from an NRI perspective, they needs to understand that how their allocation needs to be and which are the countries where allocation make difference. And for NRIs, I think India comes as a first place because being it a home countries, and secondly having the understanding of the market, it add value. So but before planning to look at, I think we have to understand that why everybody is talking about that this decade is going to be the for the India. So I think if you look at Indian GDP is set to double over the next 7 years. So and we are expecting it should be a $7 trillion economy by 2030. So that's a big difference if you look at on the overall basis what we are talking about. And secondly, if you look at, I think there is a big change which is happening on the ground level. So if you look at what are the three, four key things which are changing and why India is going to be the different the way it used to be earlier. I think if you look at India will drive one-fifth of the global growth of end of this decade. So I think the next wave of growth will be led by the India. So I think that's a one first foremost and bigger thing that India is going to drive the global growth. So if India is growing, then only world can grow. The second part, what are the factors which are going to drive the growth? Because that is very important to understand because that will create a conviction and trust. Because if you look at on a short term basis, you may see markets are volatile, it's are going up and down. But if I look at from a 5 to 10 year perspective or 15 to 20 year long term horizons, that those factors are going to differential. So I think there are key four factors which are changing. One is, I think, offshoring work from India. So I think that is something which is becoming a major part where globally companies are setting up their offices in India, and it is becoming like a back office of the world. Second thing, if we look at, I think last 10 years, what India has seen is that the digital differentiation. If we look at which is been started with Aadhaar and then the way whole ecosystem build up and which drive the credit growth, and we have seen a lot of new innovative things like UPI, then ONDC and all those things. So I think the second most important part is digital differentiation, which is going to be the factor of the growth which is going to drive. Third part, I think where India is working now, if you look at using PLI scheme, where which PLI is like a production link incentive, where government is giving incentive to companies to set up manufacturing in India. And if you look at the third most factor which is driving today, India is becoming like a factory to the world. So there are many areas. If you look at on the electronics, defense, there are a lot of areas where India is trying to become self-sufficient, even the export to the world, even automobiles. So factory to the world is the third thing, which is the most important part. And fourth is, I think, energy transition. Because if you look at what was the major roadblock for India growth, I think oil, because we import major part of our need for the oil from a global market. And if you look at today, the way energy transition is happening, solar and wind is becoming a major part of overall capacity creation perspective. So I think the way India is moving towards, this is going to make a huge difference. So we are trying to handle things which are our roadblocks. And I think then the way India has started, even on the semiconductor side, developing the setup, that's really remarkable, because people have not thought of India will be able to work towards that at early stage. So I think the next part, I think as we discuss, I think what is going to lead. First is I think our demographic dividend, because as India will have young population, which is going to drive. And secondly, I think many a times what we have seen that people are underestimate the leadership. I think the way at a corporate level we look at leadership as a core thing for the development. I think India also is seeing the in the current political leadership level the huge change in terms of the growth. So I think the way policy led transformation is happening, where government is focusing on the areas which are going to lead for a high growth, so which has helped a big way change, looking at Aadhaar, Jandan, then UPI, and all those things which are government is trying to build a one ecosystem where corporates can look at on the high growth side. Second thing, if you look at what are going to drive all those things, we are moving towards the financialization of assets. So today, if you look at the major part of India is going towards financial assets, from moving from physical assets. So still, we are at a 5% of equity if you look at the allocation on the overall investment. But this is something which is showing that directionally the financiations of investment is happening, that is going to drive the growth. And we can see that the way the government collection on the GST, 1.6 lakh crore plus GST collection we have average. And apart from that, income tax and corporate tax collection have increased significantly. So that is something which really shows that overall basis, even when government is reducing rates on the corporate tax and other thing, but collections are increasing, we show the way economy is going to grow. Now, now I'll take on the global, sorry, on the global interest rate part. Uh, just a moment. So just I'll take on the global market perspective, that how things are changing. So I think if you look at global interest rates are at all-time high, and what it shows a sign that now it is on at a cups of consolidation. And but the most important part, this consolidation should not lead for any sort of major fall, because there are other sectors which are impacting badly because of the higher global interest rate. So I think if you look at today how the global markets are, so I think stocks are falling like a recession. So if you see on a global market perspective, except India, and oil prices are rising like there is no interest. So if you look at the all the factors which typically used to be interlinked, they are working in a reverse way because of certain implications. So oil today, if you look at, is rising because OPEC has reduced their production. So it is not that because of the demand increase, oil is increasing. So that's the one reason now we have seen that oil also started correcting. And third, if you look at, gold is falling like inflation has gone. So that is another thing where we have seen that even inflation is on the higher side, but gold is falling. I think predominantly because the way US debt yields have increased, gold have seen the fall. But our view is that I think it's a good time from asset allocation perspective to start looking at that gold also, because whenever any sort of a global uncertainty come, gold will start working well from an investment perspective. And I think the fourth part, I think interest rates are rising, like we have a 10% inflation. So globally, if you look at, I think inflation numbers are slowly going moderate to lower side, except certain sector, but still interest rates are on higher side. Commercial real estate is falling like it's 2008. So that's another thing which is surprisingly where I think post COVID, commercial real estate have not come back significantly, and housing prices are increasing, like rates are falling. So I think that's the one thing which we are showing, that there are a lot of factors which are showing differential theme as a market perspective. Because I think that's something which we have to look at, and we have to focus on more on our investment style than looking at all these factors as a major theme. So I think I'll just not take much time on the thing. Second part on the China, because I think this is something which is becoming a major concern in terms of the global market growth perspective. I think there, if you look at the export and the GDP growth, really show a sign of a slowdown. And there, because growth was more led by government, not by the internal consumption. So that is something which is going to be a pain area going forward perspective. Same way, I think Eurozone also today, if you look at that also is showing sign of slowdown because it's more demand-led slowdown than overall basis. The major third biggest risk what we see today, I think the US economy perspective, the way their debt level have increased. So I think that is something which so almost like a 30 trillion dollar plus of a deficit today, if we look at on the debt side perspective, which is really a big concern. And I think that could be a trigger if you look at along with the way in US mortgage rates have increased. So we are trying to look at factors which are going to impact the global growth. So and savings have come down significantly if you look at on the US household perspective, especially on the lower income group perspective. If you look at the another changing trend, what we have seen in US, I think the because people are not able to manage, kids are not able to manage, so the rate of living in parents' home has been increased very significantly. So these are the trending change, and the expectation of recession has increased significantly. So the whole objective to give all this information is that how we have to plan. So I think we are not positive on US economy. We have a cautious outlook on the China and Eurozone, and what we see because of all these things. But one thing where still we see that there cannot, we are not expecting a very large correction because overall global volatility, if you look at, it is not on the higher side. So I think volatility is a very key factor to understand when we can see pain started coming on the global market perspective. So, and if you look at on the Indian economy's perspective, sectors where we are very bullish and where we see that real change is happening. One is the banking sector, which is almost like a one third of, if you look at the larger indices like a Nifty in terms of the allocation perspective, banking and financials. And there we have seen, if you look at the net NPA level, which has come down very significantly, and the overall level, if you look at the loan growth and other thing, which is showing real sign of a growth. So I think why markets are moving significantly, I have to understand what are the factors which are changing. So I think the banking and the financial sector has come out very well, and especially if you look at the PSU's bank after doing their NPA recovery and overall basis, the way change have happened. Second thing which is happening, I think investment-led growth, wherein government is pushing a lot of sectors, including railway, defense, apart from that, roads, agriculture, and the sector perspective, even private sector also increasing their incremental investment. So I think that is also leading the whole growth. So predominantly, if you look at these two things are working very well for India. That one is the investment-led growth, and second, the overall way the way banking and financial sector is reviving. What are the major concerns what we see in India? I think if you look at, I think rising oil price, weak monsoon, I think rural recovery and IT hiring is on the lower side. So what what is obvious? I think rising oil price may not be sustainable because it is not demand led increase. It's more on the supply side. So we view always that it should consolidate and come down. I think weak monsoon will have a short-term impact, especially on the FMCG side. So there we are outlook is more stable to negative. We don't see a bigger growth there coming. But and third part, I think the IT sector, yes, there I think we will not see a major growth. So it's going to be a very stable to a lower growth, not on the higher side. So I think the most important part to understand these factors that which sectors are going to drive the market. If you look at, I think India in summary, I think the way Birbal says that today India as overall growth is looking higher because globally growth has come down and we become much more stronger because other has become weaker. I think that's the one thing which we can see in the nutshell that as globally we have seen the issues, but India is not having similar issues. That's something which is driving the whole growth, and that's something which we are going to see that India overall basis, their percentage of sharing is going to increase very significantly. And the fundamental drive to that, if you look at the PAT growth of Indian companies, the way it is looks like. So overall, we are expecting 15 to 20% type of a growth. Even if you look at from a long-term perspective, that is going to drive the real growth of Indian economy. So that is something which is the most important factor, which as an investor we have to look at. And if you look at the overall profits as a part of GDP, it started showing increase. So peak was almost like a 6% of the GDP. So today we are at a 4.8%. So still we have a lot of headrooms, even if you look at compared to where we are earlier. So our view is that market will continue to do well with short-term hiccups because the profitability of companies are increasing significantly with GDP growth. I think valuation become very major part to understand that how things are going to be. So I think if you look at today, mid and small cap are no longer cheaper the way it was there at the end of the financial year in March, and where we have come up that mid and small cap will do very well. So today, I think large cap is much more safer zone compared to mid and small cap if I look at from a valuation perspective, because Nifty P, if you look at it's around the average where it used to be if you look at on the long-term average perspective. Second thing, I think market cap to GDP ratio, which shows that we are no longer at lower market cap to GDP, which shows that markets have already grown significantly, which shows that the whole investment team needs to be more buy on dip than buy everything at one shot. So our approach at this point of a time is that do a phase allocation on the investments than doing one-time investment, because these data point shows that how things going to be helpful in terms of taking an investment decision. But good thing, if you look at Indian market perspective, I think slowly our markets are becoming less volatile, which is show a good sign of a growth. So typically when markets are low volatile, you will see that market may not correct. So there are two type of a correction. One is we do a consolidation and earnings improve, then automatically from valuation perspective we become cheaper. Second is the price correction. So the way market volatility has come down, our view is that we'll see more of a consolidation than a price correction at an index level. And one interesting thing, what we have seen that even from a global investor perspective, because all the times we look at that what FIs are doing, that is going to be the deciding factor how India is going to do. But if you look at in terms of market level entry and exit perspective, I think uh, whenever FIs have taken out the money and when they have entered, I think they have entered at a much more higher valuation. So I think in case of India, especially, I think exit is easy, entry is hard. So sometimes people try to play around that. Okay, I'll exit and then re-enter. So that approach may not add value because market move in a very short period significantly, and we have seen the example. If you look at last 4 months, the way market have run up. Almost on an average 20 to 25% across. If I look at combination of large caps where they move 10 to 15%, but then small cap move 25 to 30%, and small cap move 40% around. So we have seen broad-based 20% plus move in just 3 to 4 months. So I think the most important part, markets like India, is that you have to be stay invested, and you may do some profit booking, but you cannot just take an entry and exit because move come very sharp on a short period. I think what is the way ahead? I think the way people are talking about global recession, rates are higher for longer period of a time, and overall level, I think risk of earning how things will move up. So I think from India perspective, I think what are the factors which we see going to work well? I think interest rates are now at a peak to consolidate, so we don't see further rate hike at least for time being. And oil price or expectation is that it should come down, so that will help to control the inflation also. And overall macros are favorable for India, and election side also we are expecting it should be on the positive side. So those things going to be drive the real growth if you look at from here. And if we see if any of these larger things coming up on the global decision, we may see a correction coming. So I think 10 to 15% type of correction is a normal correction, which I think any point of a time because of any global uncertainty come we can expect. But that should not be the factor for someone not to do invest. I think that would be a point where they should do more allocation. So I think the way our allocation policy would be, I think we can look at one-third allocation as a lump sum and balance two-third. We can do a phase plus one-third. We can keep it as a buffer when we see a larger correction coming towards 10 to 15% type of a larger correction. I think if you look at the composition of the Indian companies perspective, if you look at it is changing very significantly. I think small cap slowly has become a larger part of the overall market contribution, which is require also the way I think the growth of India is more domestic one than the global dependent. And if you look at large caps, have been steady to 67%. So that shows that how overall Indian economy is having a broad-based rally. And I think mid and small cap at a premium. So we are not suggesting any lump sum allocation on mid and small cap side. Overview is that do some SIP and STP way allocation instead of doing a lump sum allocation. Where we see a risk, I think companies which are having a low float and because of that price have moved very sharp in a very short period. These are the risk factors. So I think that's the most important part. But I think most of the good funds will not hold these type of companies. The next part, I think, destination from an investment perspective for NRI. The reason I have taken a lot of time on how the global markets, because that creates some level of trust and confidence as an investor that yes, India is in a better shape compared to global. So even if India correct, recovery is going to be better side. I think what are the things which you look at? I think globally, if you look at, I think India level remittance have almost $112 billion if I look at, and where most of the money which is coming up, if you look at on the investment avenue. So I think these are the typical investment avenues which look at, which includes mutual funds, stocks, investing in fixed income, which is typically NRE or FCNR deposits, real estate, PMS, AIF. So maybe I'll take some bit of thing that what all things we do it as a NRI services apart from investing, helping on the overall perspective to take care of their transferring, legacy planning, retirement planning, and do a complete end-to-end services to take. So we'll just the reason I'm taking some of the funds to give you that understanding how Indian markets have seen growth. So these are some of the good mutual funds where they have seen very good growth. So the whole idea of giving, so these are not recommendation that to invest, but we are just giving some example that how different funds have delivered and the way they have delivered alpha. So for example, Parag Parikh Flexi, which is one of the best performing and our recommended fund. If you look at last 5 years, it has delivered almost 20% type of a CAGR. 3 years, 20%. So in Indian market, you can expect 15 to 20% type of a growth if somebody keep it more than 5 year of a view, and funds have delivered better than index also. Then another fund like ICICI multi cap. So that has also, if you look at, has delivered 15% around growth. So the whole idea of this to see suggest that uh, actually people have made money, but the only point they have to be stay invested for a longer period of a time. And these are some of the PMSs. So first part as a starting step, what we normally suggest mutual fund is a starting step. Next level PMS could be the area where somebody wants to have stock level concentrated portfolio, and these are some of the good funds which we typically recommend on a allocation perspective and how they have delivered. So including our PMS and the other funds like ICICI, Motilal, Marshalls, ASK, Carnelian. So if you look at on an average last 3 years on the multi-cap side, we have seen 25% type of a growth like in our fund, RX Flexi Cap or First Global, or if you look at other funds which did well on mid cap, I think ICICI Pipe 45%, 43. So the whole idea is that there are a lot of good options which are available from an NRI investment perspective, which can be looked at. The third area which comes is the AIF. So AIF, they typically work like a hedge funds as a long short fund. So their idea is not to generate higher return. The whole idea is that how to reduce the overall risk and give returns which are better than debt, but with less risk compared to equity, because they always do a hedging. So typically here we expect returns between 12 to 15%. So these are some of the options which, if you look at on the Indian market perspective, there on the AIF side, where they do hedging as a part of the portfolio strategy, and obvious that when markets are high, hedge funds work as a better way. And second way could be if somebody wants to do it to mutual fund route, I think dynamic funds make a lot of sense. So there are a lot of good quality dynamic fund like ICICI Balance Advantage, or if you look at Edelweiss Balance Advantage, these funds do dynamically their asset allocation. So someone looking at lump sum allocation perspective, today I think dynamic funds and AIF make a lot of sense from a 3 year perspective, and somebody looking at 5 to 7 years, then pure equity makes sense. Then next part come, I think, on the taxation angle, because that always be a one area where NRIs always have a concern that how the taxing will be taken care. So if you look at on the India perspective, whatever deposits on FCNR and NRE, they are tax exempt. Secondly, if you look at any investments which are done in the India, the tax rates are same the way it is there for Indian resident or to the NRI. So the only difference which will come that as an NRI, TDS get deducted. So instead of they pay at the end of the filing time. So these are the different tax rates. If you look at for equity, long term is 10%. Be it on the stocks or mutual fund. Debt side, today it is 20%. Sorry, I think debt post change, I think there is no difference on the mutual fund debt side. I think that part you missed it. So if you look at technically overall perspective rates, what we see on the equity, it is 10% on the long term, and for debt, better is NRI deposits and FCNR, which is tax exempt their level, and somebody who wants to build from a growth perspective, then I think hybrid funds make a lot of sense. So I think I would like to maybe take questions because I'm just trying to cover a lot of things in a short period of a time. So I think maybe with Q&A we will be able to take it. So whole idea of this session is to give gist of why India will do better than the global market, giving a reason of India growth. So if you look at on a long-term growth perspective, the way offshoring, digital differentiation, factory to the world, and energy transition, these are the four factors which is going to drive the long-term growth of the India, apart from the demographic or a policy-led transformation, whatever is happening. The second part, globally, things are on a very bad shape, be it on the Europe where demand itself is the issue, China where exports are not growing, and we are seeing a lot of unemployment and inflation also increasing there. So China also is in a bad shape. US have their own other person where that debt to economy has increased very significantly, and the way mortgage rates have increased, that itself is a risk. So what we see, yes, if global markets see a correction, India will also have an impact, but India recovery will be much more faster. So our view is that we may see half of the impact of what we have seen in the global market in India, but when recovery will come, we will do better than that. So that is the one thing what we have seen, that post every crisis on the US market, India did better than the global market because money flow moved to India. And the second most important part, we have to understand that still India level, if you look at the allocation of the global investor, it is at a very low level. So I'm telling this is just a start of growth of the market. So we can see a lot of things are happening, and the best example we have seen that or debt papers have added on the global indices. So which shows that now India is looking at major part of any of the global allocation. Yeah, so I think that's all from my side. Thank you. I think we can have a Q&A.
Thank you so much, sir. Thank you for sharing valuable insights. I will be reading out the questions which is there in the Q&A section. Meantime, I would like to request all the participants to write down your queries and questions in the Q&A section. We'll be taking it one by one. So the first question is from Mr. Ravi Rao. How should one invest a corpus value of say INR 10 lakhs? Will it be moved into liquid fund, debt fund, and then phase manner over 18 months to do STP into a BAF or mid-cap based fund?
Yeah, so I think at this point of a time, now always that if somebody is looking at investment allocation, they can look at in two way. One is part of allocation can do on the hybrid funds, 50% allocation, 50% allocation they can do STP, but not beyond 1 year of STP, because I think 1 year is a good enough time to see overall markets, and whenever there's a sharper correction, that time they can do a one-time switch.
Thank you, sir. The next question is, my cousin is at USA and he has shifted before 2 years and he wants to invest in India but don't want to change his residence status. Can he invest with the same PAN and Aadhaar card in life insurance, mutual fund or real estates? What will be the tax implication if he will not change his residence status? It's
So,
there in the Q&A section, sir.
yeah, so if someone is looking at like a US citizen from a compliance perspective because of the FATCA regulation and for US and Canada, there are only selected set of funds where they can invest in terms of the allocation perspective. But yes, they can do it provided they have to, based on the bank level, if they have to change their status and do the allocation. So it has to be done as an NRI if he is a US resident.
Thank you, sir. The next question is, if Indian market is promoting, why FDIs pulled out of Indian markets? Please explain.
Yeah, so I think the reason why FPIs are taking out money, it's more their based on their global allocation perspective. So, and you have seen one of the slides which I have shown earlier also. I think if you look at the timing perspective, they are not worked well. So I'm looking at their actions. If we take a call, typically you are tend to lose the money. So they enter if you look at when markets moved up and they exit at when markets are at a bottom. So and second thing we have to understand that today because of mutual fund SIP and the way the PF level ETF allocation and ULIPs and other things, Indian investors are becoming a very major part of the allocation. So it is not like the earlier days where based on the FPI allocation market used to move. So today, India is moving on a transition phase where Indian investors are going to derive. So that's a more thing is that don't take your investment decision based on what FIs are doing. Actually, it's going to work other way around. They will enter when markets have already moved up 15 to 20%. So typically they come after a move up and they exit at a bottom. This itself you can see from the data. So on aggregate level, so
Thank you.
there most of the time exit is based on their global allocation because India still we have to understand is a very small part of their global allocation. Once it become as a major part of allocation, then you will see these type of things will not be happening.
Thank you, sir. The next question is, pen block for NRIs while they are not getting timely reward from income tax team. What do you suggest for this operational challenge or block or KYC?
I think one thing, if we look at and take a help of a professional companies who take end-to-end management, I think all these operational issues can be taken care. So today, for NRIs to manage investment themselves will becoming very challenging because of all these documentation and changes. So that's where I think these things are manageable, but it need experts who can help on that side.
Thank you so much, sir. The next question is, if we have to invest lump sum now into a hybrid fund, what should be the max ticket size you would suggest, assuming corpus is of 10 lakh, 6 year away from retirement phase?
What is the corpus? So I think at least one third of the overall allocation can be done on the hybrid side. So today, overall, our view is that someone who's looking at 3 to 5 year perspective, I think they can do at least their one third of allocation on the hybrids. One third they can keep it on a debt allocation and balance one third STP way they can go to the equity. So that whenever we see a larger correction, the debt allocation can be used to move towards equity.
Thank you, sir. I will take the questions from the chat box. We are having few questions there. So the question is from Mr. Manoj Jain. I'm leaving job, getting back to India, and if I will invest FCNR account for 5 years on maturity, I will not be an NRI. Then what tax will be applicable?
Yeah, so I think the if you are as per the RNR after last 10 years you being at 9 year or being at NRI, so till the time whatever the earlier deposits you have done, those will be tax exempt. even post status change perspective also.
Thank you, sir. The next question is, debts are similarly considered as equity. Would it be prudent to invest in convertible notes or debentures in foreign currency in offshore wind?
I think the most important part here, I think, to take the understanding of the risk, because most of the time these complex products have a very high risk associated. So that's the most important part to understand. And second is the currency risk in terms of the impact perspective. So always that keep the simple vanilla product investing into the FCNR deposits. That is better approach. Or if somebody wants to invest on the global bond side also, there are a lot of good options are available through platform like Crystal and other, which we typically help our clients to invest to directly to invest into a good quality paper. So I think the most important part as an investor is that do what you understand and don't try to look at return is the only criteria for your allocation. Risk is the most important part, and especially where we have seen a lot of products or complex products are created where the risk is very high.
Thank you, sir. The next question is, if I take policy while in NRI, returning back after 5 years and continue policy without GST reduction, uh,
Yeah, so there'll not be any tax impact. See, maturity or any in case if anything happen, so whatever payouts come, it is tax free in India. So there'll not be any impact in case if anything happen or in case of a maturity. So GST is just if you are NRI, you are getting exemption upon the GST, but getting money side, the tax implication will not change for the NRI.
thank you, sir. The next question is, my daughter is a resident of Germany. Is it advisable to invest in India, and what are the tax implications?
Yeah, see, it make a lot of sense, especially when Europe as a whole, we have seen they will have a low growth and less investment options. So it makes sense to invest in India. And I think the taxation perspective in India, it is very clear that 10%, if you look at on the equity side, what you can see as a tax implication. And while filing in India, if your income is higher than the overall perspective, then you may lower, then you can get a refund also. So I mean 10% what you can take the tax, and based on the DTA, you can get the claim of the same in Germany. Based on their tax implication, you have to pay the balance tax there. So at least India perspective, it will be a 10% tax if we look at as a whole, and that too when you exit. So it is not on a mark to mark basis.
Thank you, sir. I think a few people wanted to know more about us. We'll be reaching out to them post session. The next question is, could you please elaborate on the concept of RNOR and the tax exemption available on returning to India?
Yeah, so I think Alunar is typically people who have been staying for a long period of a time on the as an NRI, so they get the benefit of continuing their investments without taking the tax implications. So out of 10 years, if somebody is 9 year plus being it as an NRI, they get the benefit in terms of the tax exemption perspective. So while they are returning India, they have to declare in terms of the status perspective. Then accordingly, the status based on their status, tax can be considered, and the tax exemption will given. So I think the major difference of RNR is that you get the tax exemption continuing, which is typically is not there where in other cases once you move to the India.
Thank you, sir. I think we are having two last questions which we'll be taking. Uh, what are your views on arbitrage fund? Are they better in terms of risk return when compared to pure debt fund?
I think in there are two part. One is if you look at the pre-tax or post-tax return perspective. So I think post-tax return perspective, yes, arbitrage makes sense as a combination, but there'll not be much of difference in the yield. And risk perspective, yes, they are similar to a debt, because in arbitrage also they don't technically take any risk, because they long in the cash market, they short in the future market. So the positions are neutral. So they are just taking the benefit of price difference. So there is no so risk perspective, it is like a debt, and return perspective, post tax, they are better because they will have a 10% tax implication. In case of a debt, it will be added to income. So I think based on the tax slab, some area where somebody who's in a lower tax bracket, debt fund may work better. Somebody who's in a high tax bracket, arbitrage fund can work better.
Thank you, sir. We'll take the last question. With the US dollar expected to appreciate in the near future, would it be prudent to have investment in US dollar dominated equities?
So I think we have a bit of a contra view. We don't believe that dollar can continue to be on the higher side, because the way in US inflation and the way trade deficit is increasing. So what we see that we may see some bit of a consolidation or even correction. At least India perspective, what view is that rupee may appreciate compared to dollar, at least on a shorter period of a time, because technically the currency move needs to be looked at looking at other factors, not just the past basis, the way US dollars have moved. So obvious that if you look at the inflation and the trade deficit number, I think the dollar era has gone. So I think it has a time where people have to look at things more on a rational level based on current things than just looking at the past data.